Meet Nooby. He is a crypto trader living remotely in the forest. Nooby noticed the price is different from one exchange to another.
Wait, hold on a second. Why is Bitcoin $81,000 on this platform, around $80,000 on another, and even hitting $82,000 somewhere else? This doesn't make any sense. What's going on here? Who can help me with this?
Nooby, I see you're discovering one of the biggest problems in trading. Price differences across exchanges. Let me explain. Like Nooby, you all have experienced price discrepancies between platforms when buying cryptos. This can be very frustrating when you miss out on trading at the fair price. Today, we're uncovering the mystery behind those digital asset prices, how they're set, why they change, and how exchanges determine them. At its core, we know that the price of an asset is determined by supply and demand, the point where buyers and sellers agree on a value. If demand is high, the price rises. If supply outweighs demand, the price falls. But how does this play out in real markets? Could you help us, Professor Trends?
Sure, Bullix. The key lies in finding the right balance. When supply and demand interact dynamically, they naturally lead to what is considered a fair price, the point where interest of buyers meets the interest of sellers. If market participants want to hold an asset, the price of the asset will tend to go up. Vice versa, if market participants want to get rid of the asset. For centralized exchanges, the price is determined by intermediary actors, the market makers. Market makers are liquidity providers, facilitators, who enable market participants to buy and sell. Market makers adjust prices based on supply, demand, and market conditions. This means prices can vary from one exchange to another. Market makers are providing prices to buy the ask prices and prices to sell the bid prices, as well as the quantities allocated for each price on each side. This is the order book for an asset, similar to a continuous auction for the asset. To sum up, on centralized exchanges, market makers play a crucial role. They provide liquidity by setting bid prices, buy offers, and ask prices, sell offers, as well as the quantities of assets allocated for each price on the buy or sell side, creating what's called an order book.
Thank you, Professor. But have you heard of decentralized exchanges? They're gaining significant traction as they allow owners to retain full control over their assets. Pumpy, could you shed some light on how prices are generated in these markets?
Okay, Bullix. For decentralized exchanges, the price formation process is not yet as efficient as for centralized exchanges due to blockchain limitations and lack of proper DeFi services. But a lot of innovations are coming, so that is why it is interesting to know how they work. Currently, on DeFi, prices are defined following two types of processes. First, we have AMMs, auto market makers, like Uniswap and Balancer. These platforms offer pools where prices are fixed by formulas, with no intermediaries involved. Importantly, users retain full ownership of their assets throughout the process. Then we have hybrid financial technology companies like DXDY. These companies are using both AMMs and centralized technology and services to replicate order books.
Indeed, Pumpy. To get an overall view, here is a graph of the price mechanisms comparison on these three different types of platforms. Hybrid models like DXDY merge centralized and decentralized systems, but still rely on traditional order book construction and limited liquidity. Asagaia Decentralized Order Book using 1xMM token will be a decentralized order book mechanism with dedicated Layer 2 services to interpret decentralized market makers' pools. Asagaia technology will sit in between CEX and DEX technologies and will integrate the 1xMM token to further drive its adoption and take its ecosystem to the next level. The future of DeFi is here. Stay tuned for more developments and learning videos as we redefine the landscape of decentralized finance.